Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The corn market overall gave way to a 4% drop last week after the USDA briefing surprised investors after it left production numbers virtually unchanged post the dry and hot season that we've been seeing over the past month or so. The September contract topped near 405 on Tuesday of last week. After that, it fell down late into the week where we found support near the April 21st low of 368 and change. This low appears to be a critical level for this contract this week, and we anticipate that the market may find a little bit further legs as long as it can remain above this 368 number for the balance of the week. Breaking below this 368 number would suggest that prices could very well collapse from here. For now, we believe that price stabilization may hold so long as we stay above this 368 number this week and potentially next week as well. The point of control currently rests at 378, and we can see the market is clearly well above this number here by a couple of cents, and we have resistance above at one standard deviation above the point of control at 392 and a quarter. We anticipate that this 392 and a quarter is potentially good resistance for the balance of the week, and we look for the market to toggle between this 392 and change number and perhaps as low as 368 over the course of the week. In conjunction with the USDA report, the day prior we did show that we had a support resistance level 1 that was actually marked off on our chart as the market had made its way up through volatility-based resistance overhead. Upon the demarcation of the SR1 threshold, we can then see markets often make potential reversals for a few days. And that's exactly what happened here as the market made its decline. The market made it all the way down to that 368 number that we talked about, and coincidentally, that is right at the top end of volatility-based support. Given the steepness of the decline that we saw last week, that really occurred over the course of 3 days, we are already 4 days into the move up, and we have barely recovered about 50% of the range of the loss. That being the case, and the fact that we're right up against volatility-based resistance tells us that the potential for the market making a lower high here and potentially falling back down is quite possible. We're right in the middle of support and resistance at the 180-degree mark at 382.5, which suggests to us that the market really is in a bit of indecision. Not sure as to whether or not we're going to see very good follow-through on the way up, or as to whether or not the market's going to collapse from here. Part of what we've seen is very big moves intraday in the market, but by the end of the day, much of the move has been surrendered. Yesterday, the market made very nice highs up against resistance, but ended up finishing very close to the bottom end of the day's trading range. Today, we see a similar pattern where the market opened up and made a very nice rally intraday. This time, the closing was right at the middle of the trading day itself. We can continue to see a pattern like this quite possibly throughout the rest of the week, where the market simply looks to churn on a sideways basis. The chart pattern is very similar for the December contract, with the only difference being the price at which this contract is trading. We have overhead resistance sitting right up against our 1x1 upside angle, and where support came back down to our 1x2 angle on the upside, which is this green angle on the way up. Now, the market continues to trade between key support and resistance levels, and we have overhead a point of control level of 408.5, which is one standard deviation above the true point of control of 386. So from here, we anticipate that the market could very well simply trade sideways until the trade's able to really have some great conviction as to the direction in which the market looks to go. Like the September contract, the SR1 level did also fire off on the December contract. The market fell and found support at the 180-degree mark at 382 and 3/4. From here, the market has since bounced over the last 3 to 4 trading days, and today we find great resistance coming up right at 402.5, which is right at the 90-degree mark for this contract. With only 2 more trading days left in the week, we anticipate that about 411 may be about as high as this market's going to be able to trade over the course of the week, but that doesn't mean that next week it cannot trade much higher than that. That said, we are in the midst of a weather-driven market, And so we could very well see the market have some great volatility blowing through either side of our key support or resistance levels. The soybean market did not suffer the same percentage drop as that of the corn market, but it itself did drop about 1.33%. If the production numbers that the USDA presented for the 2017-2018 marketing year comes to light, we're looking at the second largest crop on record at 4.26 billion bushels. The prior move up terminated at 1038.25, which was a 1-to-1 correspondence from the previous move up. Taking a measurement from the 919.75 low up through the 984.5 number, and then taking the next measurement from the previous low coming in at 973.5 at the bottom of the continuation move, up through the next top at a 1-to-1 correspondence is what lands at the 1038.25 number. The market essentially topped here, and from which point it kind of came down and collapsed to our quartile number just at about 981, 982. From here, the market has bounced up for a few days, just like the corn market, and we have reasonable resistance at the correspondence level of 0.618 to that initial drive up that we talked about before. That number comes in at 1013.5, and we anticipate that this 1013.5 will continue to be good resistance for the balance of the week. Resistance beyond a 1013.5 number lives at the 360-degree mark, which is one full cycle up from the 905 quarter low. That number is at 1029.5. And downside support from where we're currently trading lives at the 180-degree mark at 966.5. We're trading right around the midway point of the 270 mark at 997.75, and look for the market to potentially oscillate around this number for the balance of this week. For the November contract, we do have a critical timeline that is shaping up near July 20th. So within a day or two of this date, we could be looking at the market making a pullback up to this date, from which point the market could very well turn back down. Granted, the 20th lands on a Thursday, which means that the market can continue slightly up to sideways for the balance of the week. And then entering into next week, if the market breaks below the previous key low here that we saw from today, after having made its way up for the balance of the week, then we'd be looking at a potential nice sell-off with a nice retracement that came in about 50% of the recent decline, which could make for a move that is about as long as what we saw last time coming in, with the market coming in to about 960 to 955. We can see from this perspective that the move down yesterday terminated right inside of volatility-based support. The top from last week at 1043 was both at a quartile level as well as our 45-degree mark. The market made its decline, and as we can see here, the low that it made came in right on top of volatility-based support. From there, the market's made a nice little bounce, but we anticipate seeing a bit of resistance coming in and the market finding some difficulty getting much higher than 1030 or so. Wheat futures was perhaps the biggest loser last week, dropping 4.5%. But as we discussed previously, the market came in to make a very nice high at 568, which was in conjunction with our radial arm swing of 1.618 of the initial move that we discussed previously. This is the unit radial swing. Multiply that radial swing by 1.618. It lands at a vector that lands here. The market makes a nice move along this area here. And as we can see, the tangent to the top, or the 12 o'clock position to that circle that is created, formed for us a very key potential area of resistance overhead. From there, the market then fell and has continued to fall from that point. We do believe that key support should be coming in fairly soon, given that the recent lows that we're seeing now are very close to the last major high that the market had made. We do have a potential Elliott wave count that we had been discussing, where we have wave 1 coming in right near the 474 number, with wave 2 coming in just below, and with a very nice wave 3 action coming in. After markets make nice wave 3s, we look for wave 4 consolidations to come in, but in particular, part of why we think a potential low is coming in fairly quickly is that we do have a time factor coming in near the July 16 mark, which suggests that the market could very well find a bit of a consolidation coming in soon. In addition to the time factor, we are sitting up right against our 270-degree mark at 499.25. And if this area is actually able to hold, we do believe that a sideways consolidation could very well be underway. We have our Elliott wave count marked off on the December contract pretty cleanly here. And as we can see, our wave 3 came in very nicely. along with our sub-wave counts inside of that wave 3 movement. Here you can see the Roman numerals for the 5 wave count inside of that leg itself, and the market came in, made a nice internal sub-5 wave count inside of that wave 3 movement. Currently, we now have the market coming in, and just like the previous contract, we have July 16 as a potential time factor for this contract. We also have the intersection of our two 1-by-1 angles, and the market is actually finding good support right up against this area here potentially. It remains to be seen if the rest of the week it will hold, but we'd like to see this area hold if this market is going to continue to trace the Elliott wave count that we have outlined. One of the rules for the Elliott wave count suggests that wave 2 and wave 4, in their comparison, that wave 2 should be shorter in time and in price than wave 4. Clearly, the length of wave 2 right now is shorter than that of wave 4, so that criteria has been met. The second criteria is that the number of bars that produces wave 2 should be shorter than that of the number of bars that produces wave 4. Currently, we have 11 bars for wave 2 and 10 bars for wave 4. So in the next 2 days, if this market continues to simply sideways while still holding support, we will have enough data that suggests that a wave 4 completion can in fact be marked and may not have to wait all the way through August that we have labeled here. But given that the fundamental data for wheat suggests that we could very well be on another move to the upside in a strong fashion. Regardless, we'll simply continue to trace out to see what the market gives us, and the next key buyer's bar that it gives us could potentially be a buy opportunity. It doesn't mean that the market will exceed the previous high, given that we are inside of a wave 4 consolidation, but at the very least, if the market can give us small higher lows inside of that movement, we can incrementally start building a position where we think the market could very well give us a new high that eventually does exceed the previous high that we saw in late June. We applied the radial swing technique to the December contract as well, and that radial swing high actually happened to coincide with the 180-degree mark overhead, giving us the 589.75 potential high that the market topped off at very closely here several days ago. From here, the market has since been on a decline. Again, we believe that the potential for support coming in near this 270-degree mark is plausible, where the market looks to hold 519 or higher. From here, if the market does hold this 519 mark and then starts to trade up a little higher, we would have what we would consider a confirmed wave 4 consolidation movement, and from there eventually look for the market to exceed the previous 589.75 high. The radial swing technique works not only for the 12 o'clock mark tangent level, but it also works for the 6 o'clock level as well. Here we can see on the December cotton contract, the first time that the market came back in to test this number, that we got a very nice bounce to the upside off of that level near 66.40. From here, the market has since come back and retested that 66.40 number, and once again, we've gotten a very nice bounce off of this level here. From this point, we believe if this market's able to get back above the 68.5 number and close above this area and give us a number of closes above, that this market could very well be on its way up. Each time that it's tested the previous low, we've seen a very nice consolidation. So one of two things are actually occurring at this time. The movement that we're seeing between 66.5 and 68.5 is either an accumulation or a distribution pattern. Once this market reveals what it is in fact doing, we should see a big break out of this movement in either direction or either side. The next thing that's going to be very important for this market is the next radial swing demarcation point, which gives us August 1st as a potential time factor. So if this market continues to move sideways up into this August 1st number and then gives us a breakout near this area, we're looking at a potential viable trade near that August 1st timeline. The US dollar index finally hit our minimum price objective of 95.11, coming in and hitting that number a couple days ago. In doing so, the market now is sitting right up against volatility-based support, and the possibility of coming down to 93.42 is a little bit suspect, but it is still possible. We also have run right into our timeline, so the market essentially hit our time and price projection on the same day. In doing so, we're looking for the market to potentially bounce up from here, but this is a microcosm of the bigger overall chart that we've been tracking, that it itself has on the weekly chart been showing us another bigger Elliott wave formation. The potential bigger story then is whether or not the dollar is approaching a significant key low from which the market has now posted a very key 5-wave Elliott wave sequence where it made a major top at the end of the year last year and has essentially been in a decline for all of this year. From here, if the market does bounce, we could see a small ABC correction where the market perhaps comes back in and finds some strength up into volatility-based resistance again before falling back down again if the market is in a true strong downtrend. Crude oil continues to move up very nicely after having made a significant low in our time price factor combination. The market moved up and made a top at 47.52, from which point, if you measure that leg and do a one-to-one correspondence off of the low that came in at 43.83, a one-to-one correspondence lands at 49.08. That would be a minimum price objective for this contract to meet if it continues higher. Now that it is above the 47.08 number, the market has a very good chance of meeting that $49 minimum price objective. If the market's able to close above 50.50, that means that we are potentially in a new uptrend, from which point we'd be looking for the market to make its way back up to test 54 at a minimum. Thank you so much for joining us for our weekly market update, and look forward to touching base with you again next week.